How to avoid tax payment. Albert Einstein said it best. The hardest thing in the world to understand is the income tax. The wealthy have access to costly accounting professionals who work with them to reduce the amount of money they pay in taxes. Americans can legitimately lower their tax obligations by utilizing a variety of tax credits and deductions provided by the IRS. Awareness of one's eligibility for deductions and recognition is equivalent to leaving money on the table. Read on to learn how to reduce your tax burden partially or entirely, depending on how many credits and deductions you are eligible for. To be eligible for tax credits, many individuals must know that a tax credit is the same as getting money for nothing. Tax deductions and tax credits both lower the amount of taxable income you can deduct from your income and, in many situations, net you a tidy return. Numerous tax credits are available from the IRS for paying your health insurance premiums, purchasing energy efficient items for your home, and having a low to moderate income. Examining your purchases over the past year to see whether you are entitled to money is the key to utilizing these credits. Sign up for college. Enrolling in college is one option to benefit from tax credits or deductions. The government presently provides credits and deductions for returning to school locally or online, but you typically have to choose one or the other. There are two education tax credits available to students. The first is the American Opportunity Tax Credit, which provides eligible students with up to $2,500 in credit for the cost of tuition fees, course materials paid during the tax year. The Lifetime Earning Credit, which provides up to $2,000 off the cost of tuition fees, the course of materials, is an additional credit to take into account. Each year, only one credit may be requested. Also, remember that grants and work-study programs for financial help provide tax-free money that isn't considered taxable income. Scholarships are another tax-free form of financial aid as long as they are used for educational expenses like tuition fees, books, supplies, and equipment. Is it feasible to not pay any taxes? A tax deduction reduces your taxable income, which results in lower tax payments. If you wish to avoid paying taxes, you must make your tax deductions equal to or more significant than your income. For instance, if you and your spouse earned $24,000 in the tax year, and the IRS Interactive Tax Assistant determined a standard tax deduction of $24,800, you will not be required to pay any taxes. Remember that this only applies to federal taxes. You can also owe local and state taxes. You must anticipate making less money the following year if your eligible deductions fall short of totally eliminating your tax liability. According to the IRS, if you are a U.S. citizen or resident alien living outside the United States, your worldwide income is liable to U.S. income tax, regardless of where you live. Don't believe moving outside the country will help you escape paying taxes. It's best to seek advice from a tax expert who can assist you lowering or eliminating your tax liability without putting you in danger of being charged with tax fraud. You may simplify the tax system by saying that you pay more taxes the more money you earn. Therefore, in order to avoid paying taxes, you often need to find a strategy to lower your taxable income. And you want to do this in a way that, well, obviously preventing financial ruin, delays your income for a later date. 10 pointers for avoiding taxes. Tip number 1, develop your business acumen. It's no secret the corporations have the most sway when it comes to tax credits, deductions, or write-offs. Some of the wealthiest people on earth engage in this. Buy the golf club if they enjoy playing. Additionally, if they enjoy taking vacations, they purchase a resort. Of course, they are exaggerated examples, but the point is to get you to consider your own needs and desires and how they might relate to a business. We know that only some are interested in starting their own business, but we would still like to urge you to consider your interests, talents, and current source of income to see if you can combine them to launch your venture. Tip number 2, start investing. Delaying as much revenue as possible is the best strategy for avoiding taxes. And the majority of wealthy individuals only accept cash when it is essential. As a result, if you create a business and it succeeds, you will make a lot of money. You can certainly pay yourself well, but you'll also have to pay a lot in taxes. But here's a crucial hint. Profits that are reinvested are tax-free. Take a $100,000 profit as an example. At the end of the year, you decide to reinvest $80,000 by purchasing property, equipment, or merely a massive advertising campaign. You can earn more money next year and avoid a significant tax burden by making that investment. Of all, everyone has different pay expectations. Therefore, we advise you to consider the tax implications the next time you think about your pay and planning. Because based on your salary, that might vary by almost 50%. Tip number 3, change your location. You might not be aware that particular nations have no income taxes. You don't have to pay taxes if you make Dubai, Monaco, or the Bahamas your primary residence. You don't want to switch your citizenship? There are, however, other states that provide you with excellent tax advantages. For instance, there are no federal income taxes to be paid in Puerto Rico. Rich people have relocated to Puerto Rico to avoid paying taxes, and there are a ton of different YouTubers as well. Additionally, there are other states like Florida and Texas that don't impose state income taxes. This is likely the cause of the many persons who have relocated from California to Texas. As a result, donations to charities are tax-free. This is typically why affluent people will frequently give a large portion of their wealth to their own foundation or a person close to them. Additionally, if you are a star or anything like that, it helps your public relations. This is because most people need to be made aware of the tax advantages that celebrities receive for their charitable contributions. They only consider how pleasant and concerned the star is. The exciting part about starting your own charity is that even a 501c3 charities can deduct their expenses, items that require a function as a nonprofit. It still counts as a charitable gift if you contribute property, automobiles, or other items to your own charity. Additionally, if you oversee the charity, you may continue to drive the vehicle that was officially donated. Maximize your retirement accounts. Tip number 5. Whether self-employed or not, saving money in retirement accounts like Roth IRAs and 401ks protects it from taxation. Retirement accounts are frequently disregarded because 1, they have strict contribution caps, making it a long and steady process. 2, you must reach retirement age before you are permitted to withdraw your money without incurring fines and taxes. However, this should be considered since every little bit matters and helps. Making passive income and acquiring hard assets is tip number 7. So, if you've been thinking, man, I can't delay my paycheck while viewing movies, stop now. This tip is especially crucial if you are answered, I don't have the money or opportunities to use several of these tips so far. Let's be honest then. Tax avoidance is a luxury enjoyed only by the wealthy, possibly because they already have everything they require. Beyond that, however, they often receive monthly payments of passive income, or what some could refer to as mailbox money, without putting in any effort. What then is passive income? You must therefore acquire assets. Now pay attention. Even if you cannot avoid paying taxes today, in 2022, or even in 2025, due to the next suggestion, you can still get started right away, accumulate assets, generate passive income, and avoid paying taxes. Making charitable gifts before December 31st will lower your taxable income if you itemize. Keep your canceled check or credit card statement for cash contributions as confirmation of your donation. Additionally, you must request an acknowledgement from the charity if your donation is $250 or more. Even if you pay the credit card bill in January, donations paid by credit card before December 31st are still deductible on your tax return. Early payment of property taxes is advised. If you itemize and have a January property tax bill that has to be paid, paying it by December 31st will let you deduct the amount from your tax return's taxable income. Caution: the alternative minimum tax, intended to stop rich people from utilizing too many legal deductions to avoid taxes, could be triggered by prepaying your property taxes. Some common write-offs, such as property taxes, must be re-added when determining AMT liabilities. To determine if you are subject to the AMT, consult your tax preparer or use tax software. Other complicated plans for tax reform that are being considered aim to cut rates while also reducing credits and deductions. The House GOP tax plan eliminates deductions for several municipal taxes, including real estate taxes. It would be better to prepay your tax bill and write it off this year rather than not be able to write it off at all. Making your income equal to your standard deductions or itemized deductions is the unique approach for paying little to no taxes and making less money. For 2023, the standard deduction for single filers is $13,850, and for married couples, it's $27,700. From $12,950 to $25,900 respectively. This is an increase. Therefore, if you earn up to $13,850 per year as an individual, or up to $27,700 per year as a couple, you can avoid paying taxes. Taxes won't be due to you. The issue is that it's difficult for an individual or married couple to make ends meet with only $13,850 or $27,700 in income, respectively. So disregard the meager standard deduction. Choose the itemized deduction, which can be used for charitable contributions, property taxes, and mortgage interest. Consider already having a primary residence if you require a mortgage to pay for property taxes and mortgage interest. The government pays for your ownership by allowing you to deduct your property taxes and mortgage interest. You need to own more than just your principal property if you want to earn money in real estate. Purchasing a rental property is one option. You can benefit from depreciation and other costs related to maintaining the property when you own a rental property. As a result, your income is earned more tax effectively. The standard deduction. In 2021, the standard deduction was raised to $25,100 for married couples and $12,550 for single people. This means that any income you earn up to these amounts is tax-free. If you fall inside the 10 to 12% tax bracket, you pay no tax on qualifying dividends and long-term capital gains up to $77,000.